Hello everyone, welcome to my channel. My name is Mihai with Wolfpack Society, your Seattle real estate agent. And in today's video, I'm going to be talking about PMI. What is PMI and who is paying the PMI and who is benefiting of PMI? And what are the factors that are determining the price for PMI? Also, how to get rid of PMI. But before I dive into my video, consider subscribing to my channel. I'm putting tons of good information for educational purposes. Also, this gives me a lot of motivation to create more content like that. Let's dive in. So you probably heard about PMI from somewhere, abbreviation from Premium Mortgage Insurance. And this is actually when the lender requires the borrower to pay a type of insurance when they are borrowing the money with less than 20% down payment. So the biggest advantage and the only advantage of the borrower from this type of PMI is the ability to borrow the money with less than 20% down payment and kind of save up this time of saving the 20% for the home. Because for depending on your saving habits, it can take you a long time to save up 20% from like 600, 700, 800,000 home. So taking in consideration that the average down payment in US is from 5 to 7%, this is a huge advantage for the borrowers to get the loans with less than 20% down payment and then build the equity over time when the property values go up. So this type of insurance is paid by the borrower, but the financial institution, the lender, benefits of it. It protects the lender, not the borrower. And many times PMI is confused with different type of insurances like home insurance, for example, which insures the homeowner, insures the building and the people inside. This one is quite different, right? So now let's talk a little bit about the price for PMI and why the price for PMI differ. So first thing to understand is PMI is directly proportionate with how risky the loan is or how risky you are as a borrower. And there are a couple of factors that determine the price for PMI. And first one is the down payment amount. So the lower the down payment, the higher PMI. The higher down payment, the lower PMI. So if you're paying 3% down payment, your PMI is going to be high. If you're putting like 13, 18% down payment, your PMI is going to be much less. Second factor that determines the price for PMI is your credit score. So basically your credit score shows to the lender how good you are with your finances, how good you're paying your loan backs, how good you are at paying your loans in time. Also, they look if you have late payments or bankruptcies or you're maxing out on your credit cards. That means you're not really managing your finances well. That means the PMI is going to be higher. If you're good with your finances and you have a higher credit score, your PMI is going to be lower. This is another reason why you should take care of your credit score because you're just going to get better deals. Next factor is your loan type. So the fixed rate mortgage loans, they're usually more straightforward and they're much simpler loans. So the mortgage insurance is going to be lower. And for adjustable rate loan, they're more complicated. They're more complex. With adjustable rate mortgages, the PMI is going to be higher because this type of loans are more unpredictable and riskier. Some other smaller factors that are determining the price for PMI is your property type, your DTI, meaning your expenses, your recurring expenses that you have every month in comparison with your income monthly. Also, your property value that you're trying to purchase, that's playing another role. But as a general rule, you should expect to pay in mortgage insurance somewhere from 0.1% to 2% of the loan amount annually in PMI. So now let's get to the point of how do you get rid of PMI? How do you speed up the process? Because nobody wants to pay for something that you're not benefiting of it, right? So first is make extra payments on your mortgage. Let's say you have a monthly payment of $2,500 a month and you pay, instead of $2,500 a month, you pay $3,000 a month. So that means that $500 is gonna go straight to paying off your principal. That means when they're going to get to the point to recalculate the loan, this is what they do every year in order to figure out what interest you should pay for the next year. So they will say, okay, the principal is smaller, that means the PMI is going to be smaller. So basically, it's very simple. The higher you go in your equity, closer to 20% down payment, the lower your PMI is going to get over time. So this is actually very simple. When you go up in equity and you get closer to 20%, your PMI is going to be lower, and at 20%, you can request the loan institution to remove the PMI from your loan. Not all the time this can be granted, because if you have missed a payment, or your credit score is bad, or some other stuff on your credit records shows something negative, they will probably not remove it from your payment, but they are required to remove the PMI at 22% equity, regardless of what's going on with your credit score and everything. So at 20%, you can request to remove the PMI. At 22%, they automatically cancel the PMI. So this is how you speed up the process to get rid of a PMI. Second option of getting rid of PMI is using the natural appreciation of home values. So let's say you buy a property for $600,000 with 5% down payment, right? And then after 3 years, the property from $600,000 goes to $750,000. So now you have more than $150,000 in equity in that home. That means it's over 20%. That means, boom, you have the opportunity to refinance and get all that equity on your side and say, okay, guys, I have 20%, remove the PMI. All right. So, but you have to be very smart with the refinance, because if the trending rate at that time when you're going to do the refinance is going to be higher than the initial interest rate when you got it, when you opened the loan, then probably you don't want to do refinance with the higher interest rate. You have to do it with a lower, when it's lower or equal, right? So you do that, and then they remove it automatically. So this is a generalization of PMI. I hope you find this information useful, and if you find my content interesting for you and valuable, consider subscribing to my channel. Also, if you have more questions about the buying process or selling process, or the current market condition, or PMI, let me know. My contact information is in the description of the video. I hope you find this information useful. Again, thank you so much, and seeing the next one. And what are the factors that are determining? So this basically gives this type of insurance usually protects this type of insurance usually, and also many times PMI is so there are a couple of factors that and first one is, so the lower the down payment amount, the higher the PMI. The higher the PMI, the lower, because at 22, but they cannot keep up, but they